Okay, let's unpack this.
Let's do it.
Today we're diving deep into Dragonfly Energy, ticker DFLI, because you, our listener, really want to understand what I think is one of the biggest paradoxes in the energy market right now.
It is a huge disconnect.
You have a company reporting, significant double-digit growth.
Right.
And yet the stock is just sitting there near its all-time lows, hovering just over $3.
It's the ultimate mixed signal. So I think the core mission of this deep dive is to take that analysis report you sent over and really figure out if this divergence, strong operations versus a super weak stock price is a trap.
A market trap waiting to snap shut.
Exactly. Or is it a genuinely overlooked contrarian opportunity in a, let's be honest, a highly volatile sector?
I just find the whole thing genuinely baffling. How can a business be growing at 25% year over year, and in a contracting market no less, and the financial markets are pricing it like it's heading for oblivion?
Well, the short answer is that the market is trading DFLI based on current financial anxieties and, technical weakness on the chart.
So not the actual performance.
Not the operational performance or its future potential, and that's why it is inherently a high-risk, high-reward proposition. But we can't just stop there.
No.
We have to get past the noise and figure out why some analysts are starting to see Dragonfly as, well, the diamond in the rough. Is that operational strength enough to overcome everything else?
Okay, let's start with the facts, the stuff the market seems to be selectively ignoring. Let's talk about that Q3 report.
Those Q3 numbers are they're the backbone of the entire bullish argument.
Oh, right.
They reported net sales of roughly $16 million.
And the big takeaway from that number is the growth.
Right. It's an increase of about 25.5% year over year.
25.5% is massive, but I feel like the context here is everything, isn't it?
It truly is. What's so surprising is that this growth happened while the company's main markets, we're talking RVs, off-grid segments, have been struggling.
Struggling severely.
Yeah, we're seeing their competitors in similar battery spaces reporting flat or even shrinking sales.
Because people are tightening their belts. RVs are discretionary purchases.
Exactly. And yet Dragonfly isn't just surviving. They're growing against these really profound sector headwinds.
So they're gaining serious market share while the overall pie is actually shrinking. How are they doing that? Where is that growth coming from?
So what's fascinating here is that the growth is very strategic. It's coming from two complementary drivers.
Okay.
First, you've got strong OEM sales. That's original equipment manufacturer sales.
So they're selling directly to the makers of the RVs.
Precisely. Integrating their lithium batteries right on the assembly line. And second, they have their very established consumer brand, Battleborn batteries.
And we know Battleborn is kind of the premium player in that RV space. They command this loyal, high-margin customer base. But that OEM growth, that's the big step, right?
It absolutely is.
It means they've moved beyond just selling replacements to becoming like an integrated part of new manufacturing. That's real operational scale.
It's a huge signal of trust, of reliability, and the ability to scale production. It gives them a fundamental security that, aftermarket sales just can't offer alone.
And it's not just volume, is it? Are they making money on these sales?
That's maybe the most important part. Their gross margin improved significantly. It's up to nearly 29% this quarter.
Which tells us what?
It's a critical indicator. It tells us they're finding efficiencies, maybe reducing input costs, or they just have pricing power. And to improve margins while you're scaling up production like this, that points to really strong operational execution.
Wait a minute, though. Let's push back on that for a second. Gross margin of 29% on $16 million in revenue? That's what, about $4.6 million in gross profit?
Roughly, yes.
But we know they still posted a huge net loss. Is 29% actually that impressive when they're still losing $11 million overall?
That's an important question, and it really gets to the core friction here. You're right, 29% is good, especially with scaling costs and R&D.
But that's not enough.
It is clearly not enough, not yet, to cover their massive operating expenses. The size of that net loss shows that this company is making a huge bet on future growth, that, it far outstrips their current revenues.
So they're sacrificing short-term profit for a long-term pivot.
That's it, exactly. They're burning cash to fund a pretty dramatic pivot.
Okay, that bridges us perfectly into the next segment then. The current business, RV batteries, it's strong, it's growing. But the market anxiety is rooted in those future costs. So we have to shift from today's performance to that high-risk, high-reward bet on tomorrow.
We have to, because the real bull thesis isn't just about winning the RV market. It's about a potential revolution in how they make all batteries.
Here's where it gets really interesting for the listener, because this is the move from a successful battery assembler to a potential tech disruptor. Let's talk about the X factor.
This is the crux of why you see those $15 or $20 price targets. The bull thesis hinges almost entirely on their proprietary technology. Dry deposition, solid-state battery tech. Dragonfly is heavily, heavily invested in commercializing this. If they pull it off, the entire identity of the company changes overnight.
Okay, we hear solid state all the time. For our listener, maybe prepping for a meeting, what makes it the holy grail, and what specifically is dry deposition?
Great question. So, current lithium-ion batteries. Think of them as using wet chemistry. It's like making bread dough with water.
Okay.
You mix chemicals into a slurry with solvents, you spread that slurry on foil, and then you have to spend a ton of time, space, and energy drying it all out. It's slow and expensive.
And solid state changes that.
Solid state replaces the flammable liquid with the solid material, which is safer and lets you pack more power into the same space. But DFLI's real innovation is the dry deposition manufacturing process.
Dry deposition.
Exactly. Instead of that wet slurry process, they use techniques to apply the battery materials directly as a dry film. It just eliminates the mixing, the drying, the solvent recovery, all of it.
So if they perfect this, they cut out the slowest, most expensive, and most hazardous part of making a battery.
Precisely. And that's why the leap is so massive. It reduces costs, it shrinks the factory footprint, and it speeds up production.
And it makes them a tech owner, not just an assembler.
That is the crucial distinction. It moves them from buying cells and putting them in a pack to owning the IP for a next-gen manufacturing method. That's what justifies those high upside targets.
So you have this high-risk tech bet combined with their strong current performance. And it creates a really interesting position, especially with timing.
It does. The analysis report highlights that while the RV market is soft now, it's projected to recover, and probably recover significantly, around 2026.
Driven by pent-up demand, lower interest rates, that sort of thing.
Exactly. So DFLI is cementing itself as the premium brand leader now, scaling up, securing those OEM contracts, so they are perfectly positioned to just capture that wave when it comes.
But now we have to face the cold reality of that stock chart.
The price around $3.07 is the elephant in the room.
Why? Why is the stock sitting here if the business is growing at 25%? Yeah. We need a reality check on the risks because the market isn't just being irrational.
No, it's pricing in very serious risk factors. The first one is structural and very visible, the recent reverse stock split.
Right. And for our listener, what does a reverse split signal to the market? Why does it cause so much volatility?
It's essentially just consolidating shares to get the price up over a certain level, usually to avoid being delisted from an exchange like NASDAQ.
Which is seen as an act of desperation.
Massive financial desperation. It doesn't change the company's value, but it causes huge volatility, and it tends to shake out weak hands. Anyone nervous about the future probably sold off immediately.
So that explains some of the downward pressure. But the more fundamental risk is financial health.
Absolutely. The company is still posting a significant net loss. It was about negative $11 million in Q3.
Which confirms what you said earlier. They are burning cash to grow.
And the market is fundamentally worried about the cash runway. So this raises an important question. How sustainable is that cash burn? That $11 million loss in one quarter is why the market cap is under $40 million, despite the revenue growth.
Investors are seeing a trade-off.
A huge trade-off. Do you buy the growth and the future tech, or do you focus on the cash burn, which means they'll almost certainly need to raise more capital soon?
And the market is punishing them for that future need.
Actively punishing them.
Okay, let's ground this in the technical analysis. What does the chart tell us about this $3 price point?
That range is critical. It's a major psychological and technical support level, right around $2.90 to $3.
So if it holds?
If it holds, it could be a bottom, a capitulation point. But the caution here is extreme. If it breaks decisively below $2.90, the outlook darkens significantly. The price floor would just fall out.
So this whole deep dive really boils down to that one dichotomy, doesn't it? 25% revenue growth.
Juxtaposed against a market cap under $40 million, fueled by fear over a reverse split and cash burn.
The contrast is just so stark. It really feels like the market is pricing this for bankruptcy.
While the company's results and their strategic investments suggest they're actually planning for significant multi-year growth, it's a fundamental divergence.
So let's talk upside. If they navigate this, what are the expectations from the bulls?
The upside is explosive because it's tied to that transition to a tech player. The source material points to adjusted price targets in the range of $15 to $20.
Wow.
Contingent on the success of that dry deposition tech, of course.
And even if you don't believe 15 is achievable anytime soon, I mean, a bounce back to just $6 would be a 100% gain from here.
That's the definition of high volatility upside. So the final verdict from this analysis is clear. DFLI is risky, the cash burn is real, but it stands out as a genuine high volatility contrarian play.
So what does this all mean for you, the learner, watching this unfold?
It means you're watching a stock whose valuation depends on a tech transition that hasn't happened yet, on top of a market recovery that's projected for 2026.
But the company is positioned for it.
They are. The real game changer is that solid-state tech. That future potential is so huge, it almost makes the current RV success seem secondary.
And that potential leap is what keeps people watching, despite the risks.
It does. Which leads us to this final provocative thought for you to explore. Considering their massive investment in this proprietary tech, what potential short-term news, something unrelated to RVs or OEM sales, would be the earliest and most definitive signal that their dry deposition solid-state bet is actually paying off?
Like, what announcement, short of full commercialization, flips the narrative?
Exactly. What shifts them from battery assembler to major tech player and forces the market to suddenly re-rate the stock toward those $15 or $20 targets? Keep an eye out for news on key patents, manufacturing milestones, or maybe a licensing deal with a big industrial partner. That's the news that matters most here.